Actually, now I will introduce a practical approach, bottom-up beta, but you are already familiar with these details. Actually, bottom-up beta is the same as the industry beta. So this is the beta called by the textbook Ross, Westerfield, and Jaffe, the industry beta. So steps to estimate the bottom-up beta. Step one, estimate the levered betas of firms in the same industry. You know how to do so, regressing historical returns on the individual stocks on the returns on the market portfolio, while the time period is the last 5 years and time interval being monthly. So if the firm has multiple divisions in different businesses, you can follow this procedure separately for each division. You can use a list of comps if it is complex and time consuming to rely on the entire industry, of course. Practically, it is better to use more than 20 firms to reduce estimation errors. And step two, unlevered estimated betas, the levered ones of the firms in the same industry by using each firm's debt-to-equity ratio and compute an average unlevered beta. If there are outliers, you may choose to use the median rather than the average. And step 3, lever up the average unlevered beta estimated in step 2 by using your firm's debt-to-equity ratio. If you need to follow this procedure separately for each division, you can take a weighted average of the industry betas by division, sales or operating income or the company value to get the unlevered beta for the entire firm before levering up. There are, of course, some advantages and disadvantages. Let's look at advantages first. Because each equity beta is estimated through the past returns with an error, combining many betas together increases the precision of your estimate. So the bigger your sample size, the less error prone your estimate. You don't need to have a historical data on a firm to estimate its beta through this by using this approach actually. So it's a good method for private companies. You can use bottom-up betas to value a startup, for example. So if the narrative requires the firm to enter another business in the future, you can conduct your analysis with the required return that reflects the risk of your new firm. However, you can also use the bottom-up beta you calculated to estimate the risk of the new business a company wants to enter. And cons of bottom-up betas, it is painstakingly time-consuming, and if the firm beta of which you want to estimate differs fundamentally from the comparable firms in the industry in terms of the nature of its business strategy or the business itself or its operating leverage, your bottom-up beta will not reflect the firm's uniqueness. Let's look at this real-world example. So 8 years ago, you co-founded a SaaS company, the Blue Hedgehog, with your fellow classmates from Cornell. You want to estimate the equity beta of your company by using a bottom-up beta. Although there aren't many comparable companies, you think that Salesforce, Adobe, and Workday are fair comparables given their business models and their business strategies. Actually, your sample size is still too small. You should at least have 15 to 20 comps in your model, but for the practicality of this example, we will just stick with three comparable firms. Check whether these companies have a similar operating leverage and calculate the equity beta of your company given that its debt to equity ratio is a stable 45% for the last 5 years by using bottom-up beta method and the tax rate for your company is 21%. So what would the equity beta of the Blue Hedgehog have been if the required return on the company stock um, had been 15% and use current risk-free rate and assume that equity risk premium is 6% and compare your results. So let's look at the solution. Step one, remember, was to estimate the levered betas of firms in the same industry. So that is the betas of comparables. And also remember from slide 219 to estimate the operating leverage. It is very difficult to obtain fixed costs from typical financial statements. So we will use the following approximation. Take a moving average of the percentage change in EBIT divided by the percentage change in revenues. The higher this ratio is, the more operating leverage the firm has. So let's look at the Salesforce data. Remember, we need historical stock price. So Yahoo Finance doesn't allow to download historical price data, so I used investing.com instead. For example, for the Salesforce, the ticker symbol is CRM. Just adjust the time frame to monthly, and the data, the time period you will be looking at will be from 2019 to 2023. So we have all these prices. And also remember on Yahoo Finance, actually, from the statistics section, you can actually see the beta of Salesforce. Actually, this is how Yahoo Finance estimated the beta of Salesforce given the 5-year monthly convention, and they calculated it as 1.30. Let's see what I will get when I calculate or try to estimate the beta of Salesforce. And of course, you also need the returns on the market portfolio, so you can rely on the Fred database. I put the link in here. You are already familiar with this data set. Just do the necessary modifications, modify frequency to monthly, and aggregation method will be end of period. So you will start from 2019 and will end at the end of the 2023. So remember, when you download the data from investing.com, actually it will start from the newest date to the oldest date, but I wanted to start from oldest to newest. So just use the sort function of Excel, sort by column, sort by date, and sort on cell values, and order will be oldest to newest. So when you do this, actually your data set will start from the oldest date to the newest one, and based on these prices you can calculate the monthly returns on Salesforce stock. And of course, remember, we also need to debt to equity ratios for these comparable firms. So basically, and it is the most practical way, less time consuming, just we will be using total liabilities and total stockholders equity from the balance sheet of the company. So we have this information for the last 4 years from Yahoo Finance. For the fifth year, actually, uh, you need to get the data from the SEC filings of the company. Just use this link. So the date will be 2020, and just use the 10K. So here you will have the total liabilities value and also total stockholders equity value as well. I also put the link here. Remember, we were also trying to estimate the operating leverage of these comparable firms. Of course, it is harder to calculate these values, but remember we had an approximation, change in EBIT divided by change in revenues. So for the last year, or for the fiscal 2020 ending on January 31st, you can look at the income statement of the company. You will be using revenues, total revenues, of course, and the income from operations, and you will use this value for EBIT as a fair approximation. And of course, we need the tax rate, and for the statutory rates, again, I am using the 21%, even though the company might have paid fewer taxes throughout all these years. And remember, again, for the last actually 5 years, we need, because we will be calculating the operating leverage for all those years in order to compare how actually these companies stack against one another in terms of their operating leverage. So again, you can look at the total revenue and EBIT values from Yahoo Finance for the last 4 years, and the fifth year, again, for the fifth year, you can see slide 270, where I actually use the company's financial statements to get the total revenue and income from operations values to calculate the, or try to estimate uh, the operating leverage of the company. So remember, you are already familiar with this regression procedure. Actually, we have monthly returns on Salesforce, monthly returns on S&P 500. Based on that, you can calculate the covariance, variance, and beta of Salesforce. Of course, you can also do the regression. Horizontal axis will be S&P 500 returns 5 year back monthly, and vertical axis will be Salesforce returns, again 5 year back monthly. And this is the linear regression. The slope of this curve will give you the beta of Salesforce. Again, it is the same as those calculated in these methods as well. And remember, Yahoo Finance actually estimates the beta as 130, so we have 128. So actually, the numbers are quite similar. And then remember, what we need to do is we need to calculate the unlevered beta of Salesforce. So remember, we had these values from Yahoo Finance for the last 4 years. For the fifth year, we relied on the information of the financial statements of the company. We have total liabilities here, total stockholders' equity. We have revenues and EBIT values, change in revenues, change in EBIT, and remember, change in EBIT divided by change in revenues. Actually, this is the approximation for the operating leverage. As is evident from these values here, actually, Salesforce operating leverage is not stable and varies throughout the last 5 years. Even for the company itself, actually, this is a very unstable operating leverage. Remember, we need to calculate debt to equity as well for all these 5 years. Then I calculated the average debt to equity ratio. Tax rate was 21%. And beta levered, remember, this will come from the regression analysis on the previous slides, which we calculated through the market returns and the returns on the stock itself. And then you can calculate beta unlevered. So remember this equation. This is the very important equation. We have been using this throughout the chapter. So levered beta will be equal to unlevered beta multiplied by 1 plus 1 minus tax rate divided by the debt to equity. So just plug in the numbers. So beta unlevered will be beta levered. This value divided by 1 plus 1 minus tax rate. Tax rate was 21%. And for the debt to equity ratio, you need to plug the average debt to equity ratio. So beta unlevered will be this value for the Salesforce. And I also calculate the firm value as well. So just add total liabilities and total stockholders equity to get the firm value. Actually, this is the book value of the assets of the company. I also calculate EBIT the revenues as well, but you won't be using it. EBIT and revenues are only used to have a or to get an approximation for the operating leverage of the company. And on the next slides, actually, we will be following the same procedure for Adobe and Workday to estimate their levered betas and unlevered betas.